Hello, students. Welcome back to Economics Simplified with Favor. If you're new here, thank you for tuning in, and I'm sure you'll have a great experience. And if you're a returning student, welcome back. This channel is all about simplifying complex economic topics into simple everyday concepts and examples that everybody can relate to. And this series of video is covering Introduction to Microeconomics, as in MICRO. And we're using the textbook by Gregory Mankiw. Either the 9th or the 10th edition is fine, called Principles of Microeconomics. And as usual, my name is Favor Olarewaju, aka God's Favor, and I'm happy to be your instructor for this class. So before we get started into the nitty-gritty of today, don't forget to subscribe so that you get regular updates, like and share this video to other students who might find this beneficial. And today we're going to be covering chapter 21 on income inequality and poverty. So this is a very interesting topic because that's something that we all see in our day-to-day lives all around us. Starting off, when is income inequality and poverty more pronounced in society? It's usually more pronounced in what we call market or mixed economies right here. So what is a market or mixed economy? It's simply a system where both the private sector and the government work together in running the system, in allocating resources. So the country is not only managed by the government, there are also private individuals that are running businesses and allocating scarce resources efficiently, and then the government only steps in when there is a market failure. So I've talked about this in earlier chapters. So that is what is a market or a mixed economic system, and this is common in most countries of today, like the US, United Kingdom, South Korea, France, Canada, and several other developing and developed countries. So in this kind of market or mixed economy, that is where you are most likely to see a wide variation of income groups that could eventually lead to poverty. So different countries are prosperous at different levels. And this is very different from the command economy. In the command economy, it's a strictly autocratic economic system that is managed by the government. So the private individuals, businesses have no say in how the society is run. The government manages all business transactions, manages all allocation of goods and services. So it's a very stringent economy. And in such a command economy, it's very rare to have individuals at varying income levels because everybody is pretty much at the same level and gets the same allocation of resources by the government. And a good example of command economy or countries that practice something close to command economy where the government strictly manages all resources includes countries like North Korea, Cuba, China, and Vietnam. So therefore, in a mixed or a market economy, since we have so much variation in the allocation of goods and services by both the private individuals and the government, then prosperity is not always equal among individuals. So that is what leads us to the concept of income inequality and poverty. And labor is the major input that influences production, and then in turn that influences the standard of living of society, right? So what that means is that how you're able to render your labor services determines the kind of wages you get paid, and that in turn determines how prosperous you are and the kind of living standard you can afford, right? So again, that is very much applicable to a market or a mixed economy compared to a command economy where everybody is pretty much at the same level. So labor acts as a human capital, and that is pretty much how much skill that you're able to offer. So it determines your skill, your ability, and that in turn influences what we talked about in the previous 2 chapters or so, where we talked about compensating wage differentials, right? So based on how skillful you are, then you're going to earn a different income, of course, based on different other things that affects wages. And also labor unions play an important role in determining the wages of employees or workers. There could also be discrimination where we talk about labor and the wages you receive in return. And the government can step in, bring in policies like minimum wage laws to ensure that workers are paid, at least the barest minimum. And then as your skill also determines what we call efficiency wages. So if you're very skillful, then you probably will be earning a higher wage than someone who just, isn't as skilled. And labor also influences what we call monopsony. So monopsony refers to one buyer, right? So if you have only one firm that's employing majority of people in a particular city, then that firm has, an advantage, and then the employees would have a less negotiating power in terms of wages, right? So, but all of that relates to labor. So labor is the input that determines your skill, wages, all of these things that I've mentioned, and that still boils down to income inequality and eventually poverty, depending on how much you're able to earn in the job markets. Now, how much income inequality exists in society today? So now I'm going to be taking the United States as a case study. So as at 2020, you could have a family earning as low as $30,000 on a yearly basis on average, and then you could have a family earning as much as $300,000, $500,000 on a yearly basis, right? But in today's society, this income inequality has expanded much more, where you could have families even earning less than $30,000 a year, and you could have families that are earning millions in a year, right? But those families earning millions in a year would probably be like in the top 1%. So on average, let's just even say this could range to about $900K yearly. So that's how much income inequality varies by a lot. And of course, this also varies a lot across different countries. So this range would be very different for a developing country or a less developed country because the income levels will be much lower and the income variation might be smaller. Now, how many people live in poverty? First of all, what is poverty? Poverty refers to how many people or families are below the absolute poverty line. So what is an absolute poverty line? The absolute poverty line refers to the barest minimum earnings that a person needs to cover their basic expenses, including like having a good meal, basic clothes, basic necessities, including shelter. For a single person, this minimum poverty line or the absolute poverty line is about $15,000 a year for a single person. But for a family of four people, so maybe like, mother, father, and two children, for example, a family of four people, whoever the four people comprise of, the absolute poverty line is about $31,000 as at right now. So meaning that a single person that is earning less than $15,000 on a yearly basis falls in the poverty category, right? And then a family of four that earns below $31,000 on a yearly basis falls under the category of poor people, according to the government. And again, this varies for different countries. Something interesting to note is that poverty is correlated with race, age, and family dynamics. And I'm going to explain how. So for instance, statistics show that in terms of race, Black people tend to have a higher poverty rate compared to the white people. And this is due to varying socioeconomic conditions where on average a Black person doesn't have access to the kind of resources, in terms of like the living area, the houses, the education, and even finances, as well as the white person does have access to those resources. So the living conditions are very different. And that is why there's such a strong positive correlation between the Black race and poverty level. But again, over time, this has greatly improved as we see more Black people that are able to climb the ladder and do better for themselves and bring their families out of poverty. In terms of age too, the younger a person is, the more likely they are to be poor, right? And that is because a younger person doesn't have as much skill or experience compared to an older person. So usually in terms of the life cycle of a person, you see that a younger person tends to have like a low income level. I mean, you don't really start working until at least maybe at 16 or 18 years old, depending on the country you are in. But as a person increases in age to like 20s, they get a good job, they start getting experience, their income starts increasing all the way to they're like 30 years, 40 years. Usually at 50 years, that is when an individual experiences the highest form of income, in their lifetime earnings. And so you see at 50 years old, people reach the climax, the peak of their income earnings, and by the time they are getting to retirement age 65 years old, then their income begins to fall down again, right? So pretty much the younger a person, the more likely they are to be poor, and as they get older, 10 towards 50 years, they tend to be more stable financially. How about family dynamics? As expected, the more people are in a family, the more likely they are to be poor because taking care of children is very expensive, from education to feeding and all of that, and even clothing. So the more children you have, the more people are in a family, the more money will be spent on maintaining the family. You spend more on water bills, utility bills, and the likes. So that positive correlation exists. With higher number of family, the more likely they are to be in a lower income brackets. How about single mothers? Single mothers on average tend to experience higher poverty compared to a family where both the mother and the father are present. Because if both father and mother are present, then they're able to work together and merge their income to improve the status of the family. But if it's just the mom, a single mom or a single dad, then it's way harder to maintain that family dynamics, especially for a single mom, to maintain such income level. Us an idea of like the poverty level. It doesn't show us the full picture. So what are certain things that are not accounted for in the poverty rate? One thing is the taxation and in-kind transfer. So poverty rate applies to pre-taxation income levels, right? So for instance, when we talked about the absolute poverty line, so that $15,000 poverty line for a single person is my pre-tax level, right? So how much do I earn before taxes are charged? And then that determines if I'm in the poverty level or not. So therefore, the poverty rate doesn't account for taxation. And that could make a difference because if one is paying a lot of taxes, then even though your pre-taxation income level is above $15,000, then by the time you get finished paying all these many taxes, your post-tax income would be way below the absolute poverty line. So technically, that person should be considered poor because at the time they are done paying taxes, they have an income level that is way below the absolute poverty line. But again, the poverty rate doesn't account for tax. So you see that it doesn't show the full picture. Also, the same thing with in-kind transfer. So when it comes to like, for instance, unemployment benefits, people that are unemployed and get certain benefits, or even people that, we have like food pantries and all these different places where they give donations and cash transfers to people that are earning below a certain income category. So poverty rate doesn't account for all of those extra cash payments or transfers that are coming in. So, for instance, during COVID, a lot of people got COVID stimulus checks where they got some extra income from the government. Poverty rate doesn't account for all these extra like cash payments and transfers that come in to help low income families. The next thing is the economic life cycle. So again, poverty rate doesn't account for the fact that at different points of an individual's life, the income varies based on age. I mentioned this that younger people tend to earn less income, and then the more they age, closer to 50, they earn higher income. But the poverty rate doesn't account for all these variations across age, or even the fact that, for instance, even as a student, even though you're not earning income, you're technically not poor because you have your family inheritance, you have your parents supporting you financially. You could borrow from friends to take care of an emergency bill. You could even use out of your savings, right, to take care of a period where you are temporarily not working. So the poverty rate doesn't account for all these things in the economic life cycle where people are able to save, borrow, or, live off of family inheritance and the likes. And so technically, even though somebody is not earning income and they should fall within the poverty rate, it doesn't mean that their living standard is low because they have all these other buffers, all these other things that they're relying on to get by on a day-to-day basis. So therefore, poverty rate doesn't necessarily reflect living standards all the time. It's missing in accounting for poverty rates or measuring poverty rates. Another thing that poverty rate doesn't account for is transient or temporary income versus permanent income. So for instance, if I receive a $5,000 gift, it's just a gift, right? That is not going to cause any permanent changes to my spending because that $5,000 is just a gift. I'm probably just going to spend it on something one time and move on. It doesn't affect my spending for next month, right? Because that is a one-time gift that I got. As opposed to if I get a $5,000 raise at work, right, on a monthly basis, then that is definitely going to affect how I spend every month moving forward, right? So poverty rate doesn't account for the differences between a temporary income or a permanent income and how that could affect lifetime spending or changes. So therefore, the fact that a person is poor doesn't always mean that they are on the lower income spectrum. It could just be a temporary thing that is going on, a temporary situation that probably would end in a couple of weeks or months before the person gets back on their feet. Or even if it's not temporary, they might have family or friends that are helping them get through that situation so they don't actually live off as poor. So how often do people move between income classes or income groups? This is what we call economic mobility right here. Bottom income group to like middle class or middle income group, then that's a switch. That's a movement, right? From low to middle class income group. Or if you're able to switch from middle income to high income, right? That's a transition as well. Or it could be vice versa where you were very rich and then maybe you made a bad investment choice and then you come down to the middle income class group. But yeah, so that's basically what this question is referring to, people moving in between income classes. And that happens a lot. Like I mentioned, it's more common for people to experience a temporary or transitory poverty where it's just a temporary phase in their lives. Or maybe they just graduated from school, they're trying to find a job, or they're even switching in between jobs. They just got married, they just had a child. So, unforeseen expenses come up or like more expenses come up with their lifestyle, changes. So that is a transitory poverty, right? And this is more common in society. Most times it's just for like a short period of time. It could be from a couple of weeks to maybe a year, 2 years, 3 years, 4 years. But usually over time, people get better. They find a way to like elevate their income levels and step out of the poverty or move from a low income to a medium income, and just move up the ladder gradually. And that is unlike what we call the persistent poverty, where people remain poor at the same income level, literally for like a very long time, maybe for life or for 50 years, 70 years of their life. That is very rare that people are not able to find a way to improve their living standards. But this is less common, but it happens where, maybe because they don't have access to resources, they don't have enough education, they don't have enough connections, and so they're not able to develop their skills. Imran talks about labor, so they're not able to develop their skills to move up the income ladder. So what political philosophy exists to remedy income inequality? So political philosophy just means what do people think in terms of government policies is the best way to go about improving or bridging the gap of income inequality. And the first one is called utilitarianism, and this is basically based off on utility. So what does utility mean? It means satisfaction. So how much satisfaction do you derive, or how much happiness, joy, contentment do you derive from government policies, in terms of resource allocation? So this utilitarianism is saying that the goal of the government should be to maximize the total welfare of every single person in society. So this is kind of hard to achieve because in general, it's not possible to make somebody better off without making another person worse off. So it's usually very hard for everybody in society to be very happy and fully satisfied at the same time. But that is what utilitarianism proposes, that government should redistribute income from the rich to the poor so that everybody can be better off. Now, the richer people get, the less value that money has to them. So that is why they propose redistributing income from the rich people to the poor people so that everybody is satisfied at the end of the day. Everybody is happier. The rich person doesn't really care that they lost like a few $100s, right? And then the poor person is very happy because that $100 means a lot more to them. Utilitarianism is based off on diminishing marginal utility, which is what I explained, that it gets to a point where you're having higher income and you're gaining more satisfaction, but it gets to a point where you have so much income that a marginal increase, an extra increase, dollar increase in the income is doesn't really mean anything to you. So that is known as diminishing marginal utility. So there's incentives for people to work because, they know that they're going to get paid or they're going to get income redistribution from the rich people to the poor people. So the poor people will be happy, right? So there's incentives there, but this could also lead to efficiency loss. So efficiency loss in terms of if the poor people know that the rich people are always going to have to give them something, then it might encourage people to be lazy and, not work as hard because they know that they're always going to get some income relief from the rich people, right? Based on how the government policy is. So, for example, that could be something called progressive tax, where the higher income you earn, the more tax you are charged by the government. And the purpose of charging you more tax as a rich person is so that they could give that to a lower income person so that the lower income person gets a tax break, for instance, or gets some kind of income relief, right? So that is the first policy of first philosophy. The second philosophy is something called a liberal contractarianism. What this is saying is that you should only maximize the welfare of the extremely worst people, those in the lowest income category. So this one, you don't have to focus on making everybody better off because, like I said, that's kind of hard to achieve, but you just focus on the worst of people in the society and try to make them better off. So, of course, that is known as the maximum criteria. So maximum means you maximize the welfare of the minimum income group, right? Okay, and then this is also possible by income redistribution. So there is way more income redistribution in the liberal contractarianism, but again, this is only for the poorest of the poorest of the poorest, okay? And that is done to protect them from like adverse situations, like having to live on the street and all of that. The third philosophy is what we call liberalism. So this is based on saying equal opportunities for people. So it's saying everybody should have a fair chance to a job or whatever opportunity exists in the economy. So everybody should be punished fairly for their crimes, no matter how rich you are. If you commit a crime, if you break the law, you should be punished fairly for that. Whatever agreement is enforced in society should be done for everybody. So everybody should be treated equally. That is what liberalism is saying. But as we know, the fact that there are equal opportunities doesn't mean that the outcomes are going to be equal. So for instance, if everybody has equal access to a job opportunity, that doesn't mean that everybody is equally qualified to do the job, right? So that's why this is not so realistic, is that even though they are aiming to treat everybody equally, at the end of the day, outcomes are going to differ. You're still going to have some people doing better off than other people. So these are three major philosophies that try to bridge the gap in income inequality. So now that we've learned about different philosophies or government policies that could reduce income inequality, now how about anti-poverty government policies? So these are government policies that reduce poverty in society. And one of such policies is the minimum wage laws, which I'm sure we can all relate to. So that is simply trying to ensure that the employers don't take advantage of the workers and pay them less than they deserve to be paid. So for instance, if the minimum wage is $7, so again, this varies for different states within the country, and then the government decides to increase the minimum wage to like $10, right? So that at least everybody is earning pretty much a decent wage. That is a good thing, but it could also be a bad thing because the increase in the minimum wage law benefits mostly the skilled workers. So imagine you own a business, right? And now you have extra expenses because you have to pay a higher wage to your workers. So now instead of paying $7 per hour to a worker, you're paying $10 per hour to a worker. So you would think of how to cut costs, right? And therefore you would lay off the unskilled workers, right? And make the very skilled workers, the very efficient workers to do the work of the unskilled workers basically, and just pay them the higher $10 minimum wage, right? So that is a way in which it causes higher unemployment to unskilled workers. So even though the government aims to improve the welfare of people by increasing minimum wage to reduce poverty, at the end of the day, it could have an adverse effect on unskilled people or younger workers who don't have as much experience. Another anti-poverty policy that the government could implement is welfare programs. So this could include things like temporary assistance for needy families. That is what this means, TANF. Supplemental security income, SSI, or unemployment benefits. And what do these mean? So temporary assistance for needy families is simply when the government provides income relief or cash relief to people who are in a low income brackets, to help them, keep afloat, especially if they have a lot of children and all of that. And then the supplemental security income is specifically to help maybe the disabled people or people that are above retirement age, to help to keep them afloat. And then unemployment benefits are those who are unemployed, they've been unable to find a job for an extended period of time, so they are entitled to certain monthly payments from the government to help keep them afloat, right? So these are things that the government implements in the United States to help reduce the poverty levels. But this could have the adverse effect of making people lazy, right? So if you know that that you're unemployed, I mean, you're going to always get paid by the government every month, then why would you even bother to look for a job, right? Especially because if you get a job, then you lose all the unemployment benefits. There's also something called food stamps, where you get donations from food pantries and all of that. You lose all of those payment support from the government. So that could encourage people to remain unemployed and not to work. It could also encourage families to split up. If you're a single mother, the government would be more likely to help you out financially because it's a lot of financial burden on you. So in that way, it could discourage people from being prudent or from working hard to improve their income status or even from maintaining their family, because they know that if they have a disjointed family, they will get more support from the government. If they have a disability or the likes, they will get support from the government. A third policy that the government could implement to reduce poverty is known as the negative income tax. A good example is the Earned Income Tax Credit, EITC. So what this means is that for lower income families, instead of having to pay tax, they get tax credits from the government. So the government then pays them an amount of money instead of the families paying tax, right? For instance, a regular family that is earning like $200,000 on a yearly basis, let's say this is how taxes, this is just a simple calculation. Let's say by the time all the tax calculations are made, they have to pay like $30,000 tax on a yearly basis, right? But versus someone who is earning $40,000 on a yearly basis, by the time the government calculates the tax, instead of them to pay tax, then the government instead would pay them, because they don't even have enough money to meet up to the tax expectations. So then the government would pay them about $10,000 on a yearly basis for being in a low income category, right? So that is basically what the negative income tax means, is that anybody who falls below a certain threshold mark of income would end up instead getting paid by the government rather than them having to pay tax to the government. Okay, so again, that could encourage people to be lazy. That's something about all these welfare policies. A fourth kind of government policy to reduce poverty is, we talked about this briefly before, in-kind transfer. So in-kind transfer is where the government provides transfer that is not cash, right? So for instance, food stamps. So food stamps is like a card that you get in the US where you could use that card to shop for groceries and whatever essentials you need for the month. And the money automatically renews every month, right? And food stamps and SNAP are in the same category, whereby governments basically provide food assistance to needy families, right? Another kind of in-kind transfer is Medicaid, where you are able to get some insurance relief in terms of getting help for your health expenses. So if you need to get checkup or you need to get some particular medication, you need to see a doctor, all of those things are covered by Medicaid, where you don't have to pay the full cost of the health expenses. So you only pay like a certain amount, maybe your copay, and then the government takes care of the rest of those health or hospital bills. So these are ways where in-kind transfer could help reduce the financial burden on low-income families. Also, something about in-kind transfers is that it is inflation protected. So because it's a transfer, it doesn't involve like direct cash, but you are getting all these like food benefits or health benefits. So no matter the inflation, you are still covered by these benefits, right? So in that way, it is better than a cash payment or cash transfer. And that is that for chapter 21. I hope you have enjoyed this lesson and learned as much as possible about how poverty and income inequality works in terms of measurements and the different instances where governments can improve the living situation and the standards of the people, and how that could sometimes have adverse effects, right? So see you in the next chapter, in chapter 22.